Hello everyone and welcome to today's lecture. In this session, we will be discussing ISA 250, Consideration of Laws and Regulations in an Audit of Financial Statements. This standard is fundamental because it guides auditors on how to address compliance with laws and regulations during an audit. ISA 250 deals with the auditor's responsibility to consider laws and regulations when auditing financial statements. Now, it is very important to note that this ISA applies only to audits of financial statements and not to other assurance engagements where compliance with specific laws is separately tested. Why does this matter? Because laws and regulations from the legal and regulatory framework in which an entity operates and failure to comply can have a direct or indirect effect on the financial statements. Think of tax laws, pension laws, or industry specific regulations. Some affect financial reporting directly, while others only affect the operations of the business but still may have financial consequences. According to ISA 250, management has the primary responsibility for ensuring compliance with laws and regulations under the oversight of those charged with governance. The auditor is not responsible for preventing non-compliance, but the auditor must obtain reasonable assurance that the financial statements are free from material misstatement, whether due to error, fraud, or non-compliance. This means the auditor cannot guarantee detection of all non-compliance, but must perform work to identify material instances that could affect the financial statements. ISA 250 distinguishes between two categories of laws. Category A, that is laws with a direct effect on the financial statements. For example, tax laws, pension laws, financial reporting regulations. Here, the auditor must obtain sufficient appropriate audit evidence of compliance. And category B is other laws and regulations that may not directly affect the numbers in the statements but are fundamental to the business. For example, environmental regulations, operating licenses, regulatory solvency requirements. Non-compliance may still have a material effect on the financial statements. For these, the auditor's responsibility is limited to the inquiry and inspection of relevant correspondence. So, for laws with a direct effect on the financial statements, evidence is required, and for other laws and regulations that may not directly affect the numbers in the financial statements but are fundamental to the businesses, limited procedures apply. What does the auditor actually do under ISA 250? Obtain an understanding of the legal and regulatory framework applicable to the entity, assess how management ensures compliance with those laws, and also perform procedures such as inquiring of management and those charged with governance, inspection correspondence with regulators, remaining alert during other audit procedures for signs of non-compliance, and also obtain written representations from management that all known instances of non-compliance have been disclosed. If the auditor suspects or identifies non-compliance, they must understand the nature of the act and the circumstances, evaluate the possible effect on the financial statements, discuss with the management and where appropriate those charged with governance. If information is insufficient, the auditor may need to seek legal advice, and if the effect is material and not properly reflected in the statements, the auditor must modify the audit opinion, either qualify, adverse, or disclaimer of the opinion, depending on the situation. Communication is a critical part of ISA 250. The auditor must communicate identified or suspected non-compliance to those charged with governance, unless they are already involved in management. If the matter is intentional and material, communication must be made as soon as possible. If management itself is involved, the auditor must escalate to the next higher authority or consider obtaining legal advice. Reporting outside the entity may be required if law or regulation obliges the auditor to do so. Finally, ISA 250 requires auditors to document the procedures performed and discussions held with management and governance, professional judgment made, conclusions reached regarding identified or suspected non-compliance. To recap, Management is responsible for compliance with laws and regulations. The auditor's role to obtain assurance that the financial statements are not materially misstated due to non-compliance. And two categories of laws exist. Direct effect laws require audit evidence. Other laws require inquiry and limited procedures. When non-compliance is suspected, the auditor must investigate, communicate, and consider the effect on the audit opinion. Proper documentation is essential. That brings us to the end of today's lecture on ISA 250. And in our next session, we will move to the ISA 260, communication with those charged with governance. Thank you for listening.